S&P 500. This is what people talk about when they talk about like the quote unquote stock market or beating the stock market. They mean the S&P 500. It is 500 of the top U.S. companies. Here's like some of them, like where's some lists, like it's like Apple, Nvidia, Microsoft, Amazon, so the big ones. And this is the performance. Here we go. So basically, 1 year, the 1 year return is 24%, 3 years 29%, 5 years 96%, and over 10 years 241%. So in the legacy, the reason why I'm talking about this is because in legacy finance, like this is the best like that you get. Like if you can beat these numbers here, you belong in working for like a hedge fund, running a mutual fund or something like that, because the average investor, and by investor I mean like people like the average mutual fund that's run by actively managed, they cannot beat this. I mean they don't beat this on average. So it's pretty tough to beat this performance. So what if we do the same thing with crypto? Does that even make sense? And so what I did is I had this idea for. So other people have had this before, but I wanted to see I wanted to see for myself if this makes sense. And here's the idea. So we have the top crypto coins by market cap, right? And what if we create like a mutual fund of sorts where we just like invest in like the top 10 coins. That's it. Like every month we DC into the top 10 coins. As they move out, we sell them, right? And buy the new and redistribute the holdings among these coins. And so I wanted to know what would be the performance of that. And surprisingly, the performance is very awesome. Like way better than this 96.1. So here, let me show you guys. But first off, let's get this out of the way. If you are in crypto, you'll hear a lot saying, well, why don't we just hold on to Bitcoin? Let's just do that. So let's try doing that. Let's just hold on to Bitcoin. Let's start with that portfolio. A portfolio that all it does, it holds Bitcoin. So the top 10, the top one is always Bitcoin. So if you run that analysis, that's the portfolio that you get if you put $100 every month for 5 years into Bitcoin. And here's the results. Let's see, let's run them. And if I run it, let's run it in real time, starting 5 years ago. See lots of negatives. It's going up, right, until into 2020. And then, let's see, goes up really high, like 400. Gosh. So it's doing pretty amazing. Like I saw like a value of like a rate of return of like 500%. There's the crypto crash, and you're starting to get negative numbers, right? So what that means, so that was in 2022. That was when the last crypto bear market, and as you saw, your rate of return was negative. That means that your portfolio value was under your total investment, the money that you put in, and that's important. Well, we'll see. And then the final return is, from now, 293. That's amazing. So let's look at let's compare again the apples to apples, right? Look at that. 10 years, 241%. If you just held on to Bitcoin for 5 years, you get 293. You beat that. You beat the stock market. Congratulations. You are an expert trader, investor, just by holding on to Bitcoin. But let's see if we can improve that. So remember how there were like negative periods during bear markets? So what if we held on to the top 10? So one of the thing that I hypothesized, right, is that Bitcoin, it's a great asset, but it's only a single coin, and so you're exposed to all of its ups and downs. And so what if you sort of added a buffer by investing in 9 other top coins? So let's do that. Let's see what that looks like. Let's run it. So it starts off negative. Bitcoin also started negative, but let's see how it performs during that bear market. So right now it's going up as well. 28, 40, 60, 99, 95, whoa, 231, 343, not bad. 434, it peaked at like 434, dang. And the bear market's coming. So there it is. Here it is. This is the year. Luna crashed. Here we go. FTX crashed. Look at that. No negative numbers. I mean, it was a zero. You got a zero return, but no negative numbers. Wow. And let's see what the final the final rate of return is. So here we go. It's climbing back up. Bear market is coming. And there it is. Wow. Wait, oh, there it is, 269. So it's, okay, let's go back to that benchmark. Where's the benchmark? All right, 241% return, 5 years. We beat that again, just by holding on to the top 10 coins. And what's nice about this is that you get a little bit more, you're spreading the risk out among those 10 coins. And so as you notice that, it didn't dip as much. So during the bear market, you didn't head into negative territory. So you do have a slightly smaller return at the expense of less volatility. So in my opinion, that's pretty amazing. Let's see if we can beat that. So one of the other things, the way that you can see that is, well, okay, in this strategy, we are dividing up the amounts of each coin proportional to their market cap. So you see here, like, we have different amounts of all these coins. What if we did something dumb? Like, what if we just bought, like, split up the, bought the same amount of every coin? Let's see what that would give us. So let's do here, get equal weights. And, the hypothesis is that we're going to get back that volatility again. So let's run it. So there it goes. It's going up again. Whoa, 536. It peaked at like 536%. So we get even better results. Gosh. And here comes the bear market. So Luna crashes like right there. FTX is crashing in November, I think. So it just crashed. And there's the bear market. Wow. Look at that. I did not see negative numbers. Damn. Gosh, that is amazing. Because honestly, here's what I was expecting. So we're getting more upside because we're exposed to more coin, more coins, right? Like, so we're buying equal amounts of like Solana, equal amounts of these other coins. So there's more potential upside. So I was expecting to see more volatility, and we did see that like big peak in whatchamacallit, we did see a bigger peak, and we did not see we also did not see a negative rate of return like during the bear market. So amazing. That's amazing and surprising. The rate of return is smaller, and I suspect as time goes on that will not hold up. That, in other words, it'll continue to increase. Another thing that I noticed here is that like this algorithm, when it buys a new coin, it doesn't rebalance. So probably if we rebalance, that'll probably make that rate of return be even better. It also might introduce some more volatility, but that's amazing. So to recap, right? If you want to beat the stock market, right, just hold on to Bitcoin. If you want a smaller rate of return and less volatility, just DCA into the top 10 coins by market cap. That is like the smartest dumbest play that you can do in crypto right now. You know, you're going to see like these amazing results just by being dumb. And in my opinion, that I think that becomes like the standard. Like that's the metric that everyone needs to beat. And if you want a little bit more risk, in other words, another more greater return, just buy equally into all those top 10 coins. Here, one other thing. Let's look at let's see if we bought more. Like let's do 20 just for shits and giggles. So here's the equal. So now we're still spreading it equally. So now we got more upside, potential upside, because we're buying more coins. So 500. Wow, look at that, 583. So it peaked even more. Gosh. And let's see, does it go down even more? Wow. Look at that. The rate of return stayed positive. Wow. Oh, nope. I just saw like a -5. Okay. Yeah. All right. So yeah. So you're getting more. Another -1 again. Look at that. So you're getting more potential upside because you're exposed to more coins, but you also got way more volatility. So you know, like with bigger risk comes more variable rates of returns, and surprising, the rate of return right now is smaller. Let's do the equal one, just to, and now just the one last thing to do. Sorry, that was the equal one. The other one. Let's do the other one. All right. So I expect this one to be smaller, because even though you're exposed to more coins, you're buying less of them. All right, so let's see what that peak looks like. Yeah, like it peaked like at 400 instead of 500. And here comes the bear market. Up 0, it just went down to 0. Okay. So it matched Bitcoin. So this one is actually not really that impressive. You're getting less performance. You're getting less performance in Bitcoin, less volatility, but less. You know, it's not doing as good as Bitcoin. So it wasn't that good. And I suspect. Let's see, what is it? Well, will it end at 263? So not bad. So so it's looking like 10 coins is like probably the sweet spot. You know, you can either like do the proportional investing or the weighted by market cap, and either way, it looks like a very promising strategy.